What if you could buy investment properties in a way that legally protects your assets, gives you flexibility in managing income, and also helps you reduce your family tax bill? Sounds too good to be true? Welcome to the world of family trust in Australia, a powerful wealth-building tool that more and more investors are turning to. Hi, my name is Molly, and I'm a chartered accountant with over 10 years experience in the industry and also a founder of Above Advisory. In this video, we'll break down what a family trust actually is, how it works, and how you can use it to buy property in Australia. Remember to watch till the end, as I'll be sharing a downloadable link of family trust checklist for free. A family trust, also known as a discretionary trust, is a legal arrangement where a trustee holds assets on behalf of beneficiaries, who are usually family members. Before I share some of the cool things about family trust, you will need to know some basic background about what family trust is and what it can do and what are the obligations it involves of having a family trust. Firstly, you have trustee. Trustee can be a person or company that legally owns the assets and makes decisions about them. For asset protection purposes, whenever we set up trustee for our clients, we always recommend for them to establish it with a corporate trustee, which means the company is a trustee. Then you have beneficiaries. Beneficiaries are the family members who benefit from the trust they receive. They can receive income, profits, or assets, and they are also the ones that eventually pay tax for the trust benefit in their tax return. I'll also explain later in this video how trust distribution works for families with different income thresholds as well. Then, family trust also needs an appointer who has the ability to appoint or change trustees. Hence, we always say the appointer has the great power and responsibility in the trust. Lastly, you need to understand that family trust will always have to act according to the trust deed. So the trust deed is like a rule book that outlines how the trust should operate, who's involved, how distribution works every year. Think of it like a container. You place assets like property, shares, cash into this container. The trustee then manages according to the rules and the income it generates and can be shared with the family who are beneficiaries of the trust. Family trusts these days are incredibly popular among Australian investors, business owners, and professionals, and here's why. Number one, tax planning flexibility benefit. The trustee can decide who gets what portion of the income. This means more and more income can be directed to beneficiaries in lower tax bracket, legally minimizing the overall tax burden for the family. However, important note on this though is that distribution cannot be solely made upon tax benefits. The beneficiaries will also need to actually receive these distributions and also benefit from the distribution as well. Number two, asset protection. Assets in the trust are not legally owned by beneficiaries and is owned by the trust, and us being human beings, we always involve ourselves in all sorts of risk. Having assets within the family trust will often protect in case of bankruptcy, lawsuits, or divorce. Number three, estate planning. You can also use family trust or discretionary trust in a way to plan your estate planning. So rather than passing down a property via a will, which can get a little complicated, a family trust can help you transfer wealth smoothly across different generations, and also help you plan to minimize taxes on transfer duties of these assets. Number four, income distribution flexibility. Like I mentioned just now, the trustee can adapt distributions every year depending on who needs support and who is in the most tax-efficient position. Imagine when you own your investment property with your spouse under both of your personal names. You will have to pay tax on the investment income based on the ownership percentage, and the ownership percentage is fixed. However, if the same assets is owned under the family trust, every year the trustee will decide who gets what percentage from the income. That's one of the reasons why a lot of investors find buying investment properties under family trust can give them some huge tax advantages. Now, moving on to the popular questions these days of if you can buy investment properties in a family trust and how does it work? Yes, absolutely. You can buy real estate in a family trust. In fact, property investment is one of the most common uses of a family trust structure. When a property is purchased through a family trust, you need to remember a few key items. The trust owns the property, the trustee controls the decision making, what to buy, when to sell, who gets the rental income. The rental income and capital gains are earned by the trust and then distributed to beneficiaries based on the trustee decisions every year. Then the beneficiaries will have to pay tax in their personal tax returns. But before you go property shopping, you need to understand how to set up a family trust and also what to be aware of when purchasing properties under one. Setting up a family trust requires very careful planning and professional advice. So get a proper advice from your accountant or lawyer, as they will also be able to assist you with setting up a family trust. Whenever we give consultation or advice to our clients regarding setting a family trust, the advice is very custom tailored to their situation, as not everyone might be in a position to be ready to maintain the family trust and its ongoing obligations and cost. Finalizing the trust deed, this outlines how the trust will operate, who the trustee and beneficiaries are, and which family members you would like to include or exclude from being beneficiaries of your family trust as well. Then you need to choose the trustee. Like I mentioned before, this can be a person or a company. Many people set up a company as trustee for added liability protection. Finally, you will need to register a tax file number and ABN. Your trust will need an Australian tax file number and potentially Australian business number if it's going to operate a business or purchase property in Australia. We assist our clients by including this process in our service of setting up family trust as well. Also, don't forget to open a trust bank account. In the name of the trust, you need to open a trust bank account. In Australia, most banks will need to identify the trustee and beneficiaries of the trust, so be prepared. You might need to make a visit to your local bank branch to complete this process. If you have been enjoying this video so far, just remember to click subscribe and hit the notification bell so you won't miss our future updates. Now, moving on to what are the key items to consider during the process of purchasing properties under the trust. Getting finance can be a little bit more complicated as lenders view trust structures differently. So loan approval may require more documentation and potentially higher deposits, and may also result in higher interest rates. When property is settled, all rental income and expenses will need to be paid from the trust bank account as well. You also need to engage with an accountant every financial year to assist you with preparing and lodging your trust tax return. Of course, purchasing properties under a family trust also comes with some limitations and disadvantages. One of the biggest disadvantages in tax is there is no negative gearing benefit that can be passed on to the individuals. So any tax losses that the trust generates will stay within the trust and carried forward to future years until the trust makes profit one day in the future. This means if the property is performing as negative gearing, you may not get that tax benefit of your rental loss immediately to reduce with your other personal income like salary. Also, in most states' governments, the rules are quite different. Family trusts have no or reduced land tax-free threshold, so this means in most states, you might find you will need to pay land tax if the property is owned under the family trust. This is something we take into consideration when helping clients prepare before they enter or purchase investment property under the family trust. For stamp duty and capital gains, typically there are also no special exemptions for trusts on stamp duty transfers and pays the same rates of individuals as well. And when the property is sold, capital gains are distributed to beneficiary. So whatever the marginal tax rate is, if the capital gains will be calculated upon that. Why are buying investment properties under a family trust getting more and more popular these days? One of the key reasons you probably heard your friends, your relatives saying they're buying investment properties under a family trust because it will allow them to grow their property portfolios faster. It is somewhat true, but not fully, and I'll explain to you why. When banks assess your borrowing capacity for your loan, if you're lending under your personal name, they look at your personal income, a lowering your personal debt balance. If you already have existing loan or finances, you may not have much borrowing capacity left. However, if the property loan is under the family trust, as long as the trust is making profit, which means the property you purchase under the trust is positively geared, the bank will not take into consideration the trust loan balance when assessing your borrowing capacity. Just by looking at this scenario, you may think this will allow you to increase your borrowing capacity and so on. Of course, banks will not just approve the finance so easily. They will need to review your trust financials, tax returns, and also a letter from your accountant confirming the trust is profitable. So you can see, this scenario seems perfect, but it can get tricky if your trust is not profitable yet and the property under the trust is negatively geared property. I know we just went through a lot of key items of family trust, so I want to give you a quick summary with pros and cons of setting a family trust in Australia. So what are the biggest advantages? Tax-effective income splitting, good for long-term wealth accumulation, offers asset protection for your family, allows for family flexibility and estate planning. Now, disadvantages or the limitations. More complex and costly to set up and maintain family trust. So the setup cost can cost you around $2,500 and maintaining the trust can be around $2,000 each financial year as well. It also requires a bit higher compliance and reporting obligations with the ATO, and like we discussed, property losses cannot be claimed against your personal income. So a family trust may be right for you if you're a high income earner looking for tax-effective investment structures among your family members, or you're building a property portfolio and wanting to protect all your assets, or you're planning to pass on your wealth to your children and grandchildren within the family trust. Lastly, you could be investing as a family unit and not just individually. It is very, very important to remember though, this family trust setup might not be for everyone. If you're just starting out or if the cost and complexity outweigh the benefits of your income level, it may not be the right fit just yet. Family trust can be an incredibly effective way to help you grow and protect your wealth in Australia, especially when used to invest in property. But like any powerful tool, they also come with responsibilities. Get the right advice, understand the obligations, and use them with strategy and care. That's all for today. Make sure to hit the subscribe and notification bell not to miss any future updates. Also, I'm going to put a downloadable link below of the free checklist for how to set up family trust. Until next time, see y'all!